Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Okay, hello and welcome to today's lesson, and this particular topic is aggregate demand. Aggregate meaning the total or sum of. And basically aggregate demand is the sum of all of the expenditure occurring in an economy. So all of the spending that's occurring in an economy. Now let's just take it from the ground up. So we know that individual demand is defined as the total number of goods and services that an individual is willing and able to buy at a range of prices. One step up, market demand is the sum of all the total number of goods or services that all consumers in a market for a particular good or service are willing and able to buy at a range of prices. And aggregate demand, the best definition that we can give you is being the total quantity of all output, and we define all output as being real GDP, that all buyers in an economy are willing and able to buy at all possible price levels. So what is a price level? A price level, the current weighted average price of a representative selected group of goods and services, such as that found in the Consumer Price Index, and that's produced in an economy in a specified period of time, and it's usually 1 year. Now aggregate demand is not just all consumer demand, it's the demand from all the buyers in an economy. And these include the demand from consumers, that's consumption spending. The demand from firms, this is investment spending, the purchase of capital goods. The demand from government, so that's government spending on public goods, health and education, transfer payments. And it's a demand for a country's exports from foreign buyers, so that's exports. And we subtract the demand for imports. That's the consumers in an economy's purchase of imports is subtracted from aggregate demand. There's an aggregate demand curve, and it has price level on the y-axis, and the price level, an example there being the Consumer Price Index, CPI, and we have real GDP on the x-axis, and this shows national incomes and total output for the economy, the total amount of goods and services produced. The aggregate demand curve slopes downwards, and it's a model of the relationship between the total demand from all of those four components we've just run through. Consumption C, investment I, government G, exports X, less imports M, of aggregate demand, and the price level of an economy within a given time period. There is a negative relationship between aggregate output and the price level, and this is why the AD curve slopes downwards. So far so good. The different components of aggregate demand, we've touched on them briefly, but aggregate demand equals consumption spending, investment spending, government spending, add export spending to that, and we subtract imports. So consumption expenditure, investment expenditure, government expenditure, export expenditure, and that's in overseas markets, and import expenditure, which we're subtracting from the equation. This is money that leaves the economy. Why our aggregate demand curve slopes downward? So we already have said that the slope indicates that there's a negative relationship between the price level, average prices in the economy, and national output, so GDP. So we can see as the price level falls, real GDP output increases. And the reasons why this happens are very different to that of the demand that we studied in microeconomics. Nothing to do with the law of demand. Reasons why our AD curve slopes downwards are threefold. Firstly, we have the wealth effect. Now, the nominal value of money is fixed, but the real value is dependent upon the price level. This is because for each dollar that we have, a lower price level provides more purchasing power for the unit of currency, because a lower price level means that on average the goods and services are cheaper, so the dollar can buy you more goods and services. Now when the price level falls, consumers are wealthier, and that's a condition that induces more consumer spending, the wealth effect. So a drop in the price level causes consumers to spend more, and that increases aggregate demand, because remember, consumer expenditure, the C part of the AD equation. The interest rate effect. Low interest rates increases the demand for investment because the cost of investment falls with the interest rate. To lower the interest rate, the easier it is for firms to finance their investments. So a drop in the price level decreases the interest rate, and that increases the demand for investment. And remember that investment is one of those components of aggregate demand. I for investment expenditure. The international trade effect. As the price level drops, interest rates fall, and when interest rates fall, domestic investment in foreign countries increases. The real exchange rate depreciates, and we've touched on this before. As the exchange rate depreciates, net exports will increase, and because exports are increasing, aggregate demand is also going to increase. Determinants of aggregate demand. So our aggregate demand curve can shift to the right, which would be an increase in aggregate demand, or it can shift to the left, and that's going to be a decrease in aggregate demand. And it's important to distinguish between movements along the AD curve. So we've just looked at that. So for example, the wealth effect, the international trade effect, the interest rate effect. Important to distinguish between those and shifts of the AD curve. Only changes in the determinants of aggregate demand, and we're talking C, I, G, X and M, are going to shift the AD curve. So consumption expenditure, investment expenditure, government expenditure, export expenditure, less our expenditure on imports are going to shift the AD curve. So a shift to the right, an increase in aggregate demand, and a shift to the left, a decrease in aggregate demand. Pretty simple stuff. Now let's have a look at each of these in turn. We'll start with consumption expenditure. Now factors that affect consumption expenditure, and these are things that are going to either increase consumer expenditure or decrease consumer expenditure. And these things will shift the aggregate demand curve. So the first up is consumer confidence. Now if consumers are confident about their future, so the economy is growing, it's stable, there are jobs out there, income's coming in, they don't worry about losing their job, spending is likely to increase. But any job insecurity and uncertainty over income is likely to delay spending. So an increase in consumer confidence is going to shift the AD curve to the right. Interest rates. Lower interest rates tend to increase consumption because larger goods are usually purchased on credit. If interest rates are low, then it's going to be cheaper to purchase those goods. One of the largest purchases that a consumer is likely to make is the purchase of a house. Now lower interest rates allow for lower mortgage payments, and if households have lower mortgage payments, then they have freed up money to spend on other goods and services. So lower interest rates are going to increase aggregate demand. Consumer debt. Now, if consumers have a lot of debt, they are unlikely to buy more, since they would first have to pay off the initial debt. And low consumer debt would increase consumption and aggregate demand. Wealth. Wealth we define as assets held by a household, so we're talking property or stocks, money in the bank. An increase in property is likely to increase consumption. Personal income taxes. Now these are taxes paid to the government by households on the income that they earn. Any increase in personal income tax will decrease disposable income. So disposable income is income after tax, and that's going to decrease spending. The opposite occurs if governments reduce personal income taxes. Disposable incomes are going to increase, consumers have more money in their pockets, and consumer spending will increase. Let's turn our attention to investment expenditure now. So factors that might affect investment and therefore shift the aggregate demand curve. Interest rates. Similar to how interest rates affect consumer spending, interest rates are going to affect business spending. So their investment, their purchases of capital goods. Typically these can run into the hundreds of thousands and millions of dollars, and firms are going to have to borrow to finance this capital expenditure. Now if interest rates are low, if they decrease, it becomes cheaper for firms to invest, and that provides incentive for firms to take on risk. Business confidence. If firms are confident about the economy, future growth, then they're far more likely to invest in capital, start new projects, and purchase buildings and purchase machinery. The investment policy is something that governments do, governments formulate. Now if governments provide incentives such as tax breaks, subsidies, loans at lower interest rates, then investment will increase. However, things like corruption and bureaucracy, paperwork, red tape, these things will deter investment. Technology. Any technological improvement is likely to lead to greater investment spending as firms adopt the new technology, and doing so they make themselves more productive or their products more competitive within the market. Business taxes. So if governments can choose to tax the profits of businesses, now most governments do, it's called business income taxes or corporate taxes. Governments can set the rate, they can increase or decrease these rates. Any increase in business taxes are going to lead to lower level of investment spending by firm, because everything being equal, an extra dollar spent on taxes is a dollar that could have been spent on investment, and vice versa for decreases in the corporate tax rate. Corporate debt. If firms have borrowed a lot of money in general to finance their investment, then they're less likely to take on board new investments and borrow further. So an increase in the debt accumulated by firms within the economy is going to lead to a decrease in aggregate demand, and a decrease in the debt of firms will cause aggregate demand to increase and shift to the right. Government expenditure. Now government spending typically forms quite a large total of aggregate demand in most Western economies, and an increase in government spending shifts aggregate demand to the right, and different governments are going to have different priorities, both political and economic. Government spending we categorize into transfer payments and capital spending. Capital spending, this is spending on things like roads, schools and hospital. Transfer payments are those payments by the governments to households, and these include things like pensions and unemployment benefits. Governments can also spend to increase the consumption of health services, education, and they can choose to redistribute income. and they can also spend to increase aggregate demand and boost economic activity. And last but not least, net exports. Exports minus imports. Factors that are going to affect this variable: the national income of our trading partners. So most countries are going to have a major export destination. Typically these are countries, markets that are very large, like China or the US or Japan, Europe, so big economies, and or they are countries which are very close, like New Zealand and Australia, the UK and France. As national incomes in key export destinations increase, everything else being equal, demand for all products in these markets increases, and that includes the demand for exports. And if our major trading partners head into economic recession, there's going to be a decrease in demand for the nation's exports, and aggregate demand is going to decrease as export receipts fall. Trade protectionism. Protectionism is an economic policy of restraining trade between countries, and governments can do this through things like tariffs, quotas, and different government regulations. For example, tariffs increase the price of imported goods. Consumers are going to switch away from buying these imports if a tariff is imposed because they become more expensive, to buying the locally produced good. And in this case, for country A, this is good because the consumption of domestic good increases, causing their aggregate demand to increase. But country B's export revenue falls, and this results in a fall in country B's aggregate demand. Trade protectionism, in theory, could boost net exports by decreasing the amount of imports that come into a country. However, any sort of protectionism is usually retaliated. So if one country imposes a tariff or a quota, then other countries are going to follow suit and impose tariffs and quotas on any imports coming into their country. So typically trade protection doesn't work in the long term. Exchange rates. Now, the exchange rate, our definition here, is the price of one currency in terms of another. It's the rate at which one currency can be exchanged for another. An appreciation and increase of the exchange rate. So the price of buying foreign currency in terms of domestic currency increases. This causes an increase in net exports and an increase in aggregate demand. At depreciation, we have the opposite. A decreasing exchange rate. The price of buying foreign currency in terms of domestic currency decreases, and this will cause a decrease in net exports and a decrease in aggregate demand. Okay, aggregate demand done and dusted. See you for the next topic, aggregate supply.